Welcome back to Global Mantra. I'm still in conversation with Sam Mahtani of F&C Investments. Sam, let's talk about the emerging market portfolio, your portfolio in general. What are the current allocations? How have you broken up your portfolio?
Well, the portfolio is, broadly speaking, overweight some of the key countries like Brazil, Korea, Hungary, Russia. That's another country where we're overweight. Broadly speaking, we position the portfolio to benefit from the strong growth we're seeing in the OECD economies. So countries like Korea, for example, are benefiting obviously from the growth in developed markets. Clearly, they're big beneficiaries as they export into the global economy, and as we're seeing strong growth in countries like the US and Europe, you'll see a number of Korean companies benefit from that.
But given the outflow that we've seen over the last 3 months, nearly $12 billion taken off from emerging markets, have you turned around your positions at a country level in your portfolio?
Not really, no. The one key call that we are debating is actually the domestic demand economies, where we have been slightly cautious. So that is, countries like India and China and Indonesia. As I mentioned earlier, we are looking quite seriously at India, but also we are looking at China and Indonesia as well. And the big call really is when you feel inflation and interest rates are fully discounted. The rise in inflation and interest rates is discounted in those 3 key markets. I think that will basically give us a good trigger in terms of allocating more money back into those markets. But at the moment, no, we've stuck with the positions that we had at the beginning of this year, which, as I said, overweight countries like Korea, Brazil, and Russia.
What about markets such as Hungary and Mexico? Those are interesting themes. We've not really heard too much about the investment opportunity there.
Well, there is an investment opportunity in both those countries. Hungary has been has been pretty brutal in Hungary actually over the last year, because the market's been sold off quite heavily. Obviously, because of its, the Hungarian market's obviously associated with Europe, and given that we've had a lot of weakness in some of those peripheral European markets, Hungary has been dragged into that turmoil as well. We actually feel the Hungarian market is actually looking quite, pretty solid value now in terms of the overall valuations. It's trading on about 7 times forward earnings. There's 2 or 3 decent companies there. And we think that the European sort of issues that we've had will gradually sort of quieten off, so that will benefit Hungary as well. So Hungary's a country we like.
Mexico?
Mexico, again, we're warming up to. We're still trying to find some more investment opportunities there, but we do like some of the companies there. Companies like Banorte, which is the largest listed private bank. That's got a good sort of profile in terms of loan growth and margin expansion. America Movia, which is the largest telecoms operator actually in Latin America. That's another company we like there. So there are some very interesting opportunities in Mexico and Hungary, which we've got in the portfolio.
A lot of people are looking at Egypt right now, but not from an immediate investment perspective. But they're looking to evaluate the region sometime down the line once the mess kind of settles down. Is that the ideology that you have as well?
Yeah, well, we've had nothing in Egypt for the past year. We're still adopting really a wait-and-watch approach in terms of Egypt. Clearly, we have to see how things settle down now. The new regime is in power. We have to see, obviously, how things pan out on the economic front and on the reform front. Obviously, expectations are quite high. I think it's appropriate to adopt a wait and watch policy on Egypt at the moment.
Do you think then that it would be important to de-risk your portfolio, especially for emerging markets, which can get impacted due to risk aversion on part of investors?
Well, we think certainly the moves that we've seen in emerging markets over the last sort of few weeks have, obviously we have seen an increase in risk premiums, and people obviously allocating money out of emerging markets. There are obviously some ways you can hedge your portfolios. I mean, Russia is a good example. Clearly, it's a big beneficiary of the higher oil price. So that is a country that benefits from a macroeconomic
But wouldn't
perspective.
that also raise a question mark about how you are putting a lot of emphasis on Russia as an oil story? And a lot of people are saying that this move in oil prices is partly speculative as well and not totally driven by supply shortage. In that light, doesn't a bit of a speculative element come in to the investments in Russia, and aren't investors extending their bets?
Well, I think yes, there possibly is a small speculative element there, but I mean, I think looking at the geopolitical situation, I think there is going to be tensions in the Middle East for some period of time. And given
how much you think? I mean, people are saying
very,
6 months.
very difficult to predict, really. It's very difficult. The situation is very fluid. But I mean, I think that will put a floor underneath the oil price. And if oil does retrace, which at some point it probably will, I don't think it's going to go back to $70, $75. I think there will be a new floor for the oil price. Maybe it's $90 or $95, but it will be higher than the previous floor. And I think that's the key thing, really. So as I said, one of the possible hedges is obviously is the Russian market. Obviously, oil and gas companies globally would be another hedge. Gold companies are another hedge as well.
All right, we'll take a break on that now. When we come back, we will talk a little bit more about emerging markets and how they stack up as far as the growth story in the developed markets is concerned.
I think clearly there has been a big kind of pushback into developed markets because of the growth numbers that we're seeing. Because of the valuations. I mean, developed markets have been derated quite a bit over the last 4 to 5 years. So there is a bit of a valuation difference between them and emerging markets. I personally don't think that the frontier markets will do as well this year. There's obviously an increase in the level of risk premium in some of those key frontier markets. Obviously, anything in the MENA region has now got higher risk profile, and obviously also we've got possibly higher interest rates and higher inflation in some of those markets as well. So I think the gloss has been taken off the frontier market story.